We all want some level of safety and security. Firefighters, construction workers, EMT. They're all there when you need them to help manage life's chaos. In retirement, you want that same level of safety, but who is there for you to make sure your money will last? Brian isn't just there in case of emergency. He's there so you don't have an emergency with your money. A safer retirement doesn't mean a boring retirement, but a prepared one, full of the things that inspire you. This is Safer Retirement Radio with Brian J. Decker.
Welcome to Safer Retirement Radio with Brian J. Decker of Decker Retirement Planning. I'm Mark Ellie. Glad you're with us today. We talk retirement. Brian's team, it's right there in the title, right? Decker Retirement Planning. And the question is, do you know where you are? Do you know where your income is going to come from? Do you know how your portfolio is set up for a market crash or market boom? You got to think if the markets are good, you're probably okay. But what if it goes the other way? Are you going to be okay? Are you going to make sure? How do you know if your money's going to last as long as you need it? If you retire, are you going to be okay? Really, all the things that are just on our mind heading into retirement, Brian and the team are here to help you figure out where you are. 833-707-3030 is the number. Again, totally complimentary. There is no cost to you to chat with Brian and the team at Decker Retirement. 833-707-3030. And every week we start the show, I always give you the opportunity to go to the website, deckerretirementplanning.com. You can find out more about Brian and the team. You can find out about the offices as well. But you can also go there under the heading of Safer Retirement Education, and there are 12 different things you can download, including Brian's book on retirement, the Decker Approach book. And Brian, that is a new revised edition of your Decker Approach book for retirement, isn't it?
That's right. We updated a bunch of things in the book.
Because you told so many untruths, or just because laws changed and that means you had to update the facts?
No, we updated some information on new models that we brought in, AI. We've had a lot of upgrades here that in the last 5 years that we've added to the book. So it's updated and ready to roll.
And we had a lot of things change from 2020, 2022. The Secure Act changed a lot of things for retirees. So there's a lot of things that are probably updated in that book because things have changed, and things always change. That's why Brian and the team are here to help you walk you through their safer retirement process. Income, investment, taxes, healthcare, legacy planning. What about Social Security decisions in the income part? What about Medicare decisions in the healthcare part? So a lot of moving pieces. Again, go to the website, deckerretirementplanning.com, under the heading of Safer Retirement Education. There you go. There's 12 different things, including Brian's revised retirement book, the Decker Approach book. It's all yours. It's all there for your information. There's no cost, no obligation, and nothing. It's just there. Grab what you want. And then if you have questions, call them, 833-707-3030. All right, so we're going to talk about some different things today, as we always do on the program. And I guess you want to kind of start with the interest rate world. Is that kind of where you're headed?
I'm going to spend the whole hour today talking about three big unknowns. Okay. Interest rates, are they going to go up or down? Markets, are they going to go up or down? And the election. What happens if disaster strikes and the person that you don't want is coming into office, and half the country swears that it's doomsday and the other half feels that salvation has come, and vice versa. So we're going to talk about those three unknowns and how in retirement you can safeguard your plan from interest rate volatility, number one, market volatility, number two, and election uncertainty, number three. So let's start with interest rates. It's interesting, Mark, that when the Fed cut rates 50 basis points, that says a lot. They had to vote, the Federal Reserve governors had to vote between the economy and inflation. And they didn't just go 25 basis points on the economy. They went 50 basis points on the economy. So they're very concerned about the economy. Or, Mark, do you think that might have been an election bump?
Come on, the Fed is not a political group. It is only doing it for the greatest, for the best needs of the American people. Now, I will say this, 2022, was when the Fed started fighting inflation. And remember when Jerome Powell, the Fed chair, said, it's transitory, it's not going to be here long. So the Fed probably got a little late start on fighting inflation, but they did raise the interest rates 7 times in 2022. They did it 4 more times in 2023. And so I think it was a total of 5.25% over those 11 hikes of the interest rate levels. And then September, wasn't it early September? The first meeting they had the meeting they had in September is when they lowered it that 50 basis points. Is that like 0.5%? Is that kind of the idea?
Yeah, 50 basis points is 0.5%. In 100 years of Fed history, when the Fed has had an inverted yield curve, meaning that short-term rates were higher than long-term rates, and when the Fed started cutting rates, that has produced a recession every single time within the next 12 to 18 months, with only one exception. So if you're a betting person, Mark, the Fed went for 50 basis points because they felt like they had no choice. They had to stimulate the economy. Now, what's interesting on interest rates, I told you that we're talking about the uncertainty of interest rates. Here's why that's very important to people in retirement. If you've got your quote unquote safe money in bond funds, you have interest rate risk. Interest rate risk is where you lose money, principal, when interest rates go higher. So that, for example, here's a little history from 1940, the 10-year treasury was at 2%. Then for 40 years, interest rates trended higher. And so they got almost to 15%. The 10-year treasury hit almost 15%. Then for 40 years, the interest rates on the 10-year treasury went down. They bottomed in 2020, 40 years later, at 0.47% in August of 2020. Now, any licensed person telling you to put your safe money in bond funds when you're at 0.47 in the 10-year treasury, we would call that financial malpractice, because when interest rates go higher and at 0.47, there's only one way for them to basically go. And of course they did. When interest rates go higher, your quote unquote safe money is down. In the last 3 years, 2.5 years, they've lost about 35% of their quote unquote safe money because of their bond funds having interest rate risk. So this is very important. When you've got a 60-40 portfolio, or which most people have, Mark, in retirement, 40% of your portfolio is in bond funds.
How about my target date fund? How many of those get slid into the bond world? Probably even higher percentage then, wouldn't it, if you're getting close to that target date fund?
Yeah, target date funds, if you're retiring in 2 years or 3 years or 4 years, you have a high percentage of your money in bond funds. So this affects people in target date funds preparing for retirement. It affects people that are in retirement with a 60-40 portfolio. I just want to say we never use bond funds for our clients, never, because of interest rate risk. There's too many other good options. So let's talk about that. How can you protect yourself? Now, we're going to get into the equity side of the portfolio too. We're going to talk about how to handle market volatility with the uncertainty of the elections. But right now, let's focus on interest rates. In the last 3 weeks since Fed has cut interest rates, it's very interesting that the 10-year treasury yield has gone up. So the bank rate has gone down. That's the open market Fed rate that they control. But the open market bond rate, that is the bond prices, yields on the 10-year treasury have gone higher. How is that possible? Well, the deficit that we have as a country is over 35 trillion. You cannot have a bond auction and move 35 trillion in inventory and drop rates very easily. So we've had failed bond auctions, and that's produced higher interest rates. And the expectation is that interest rates have to go higher because of the huge load of treasuries you've got to move. And it keeps getting bigger. The national debt is over 35 trillion, and we're running annual deficits of 1.5 to 2 trillion a year. So the when interest rates are going higher, you have people in bond funds losing money. So let's take this head on. In our client portfolio, we ladder portfolios. That means that we don't have to guess on interest rates. We have bucket one, which is a cash account, money market, earning 4.7% right now. And we use the Wink database, WINK. The Wink database lets us see the highest offerings from banks and insurance companies for cash, money markets in this case, 1 to 3 years, 3 to 5 years, 5 to 7, and 7 to 10 year principal guaranteed accounts. By the way, if you're dealing with a fiduciary, someone who's required by state, federal law to put clients' best interest before their company's best interest, you will have someone doing research like this. So we do the research for our clients and we find out where the highest earning principal guaranteed money markets are. So 4.7%, we use the Fidelity money market. Then bucket two is a 3-year CD. Bucket three is a 5-year CD. So let me stop right there. Those make money no matter what markets do. They will make money whether we have a great year like 2023 or this year, 2024 so far, or they'll make money even if we have a year like 2022 where the S&P was down 19, NASDAQ was down 33, bonds were down 20. People lost a lot of money in their bond funds, their quote unquote safe money, which we never recommend. We hope if you have bond funds, we hope you jot a note and you give us a call because there's no reason to own bond funds when there's other instruments out there. But we ladder the portfolio so that if interest rates go higher, thank goodness, we've locked in 3 and 5 years. But if interest rates go lower, we've got cash on the sidelines with bucket one, and we've got protection in the other accounts, which is buckets 4 and 5, which we'll talk about in a second. So bucket 1, 2, and 3 are fixed rate accounts. They make money no matter what. They give you peace of mind. Now, buckets 4 and 5 are the 7 and 10 year principal guaranteed accounts. When we talk about these principal guaranteed accounts, they're not fixed rate, they're variable rates. That's important because if interest rates go higher, these can adjust higher. If interest rates go lower, these will ratchet down a little bit, but their average rate of return is about 2x the CD rate. Let me say that again. The 7 and 10 year principal guaranteed accounts that we use are averaging twice the return of the CD rates. So this is something that is important to know. These are 4th generation smart beta indexes that track with 3 different markets. They allocate between stocks, bonds, and commodities on a daily basis. That's very important because when you have a horrible year in the market, the stock market, like 2000, 01, and 02, stocks were tanked. S&P was down 50%, NASDAQ was down 70%, but bonds and commodities did well. So these indexes did well. In 2008, stocks and commodities were hammered. Stocks were down 50% from their highs to the lows, and commodities were down, but bonds made over 20% in 2008. So these indexes are looking at 3 different markets. They give you diversification, and your chances of a 0 on those returns are very small. They're principal guaranteed, so you cannot lose money, but this is where we're averaging not the CD rate of which currently for 7 and 10 years is around 5, but these are averaging 9 to 11%. They're principal guaranteed. They offer a great rate, and we're able to pull, unlike a CD, we're able to pull monthly income from them up to 10% per year, no penalty. Now, as a firm, we do not offer, we steer people away from any variable annuities, income annuities, life annuities, or income riders categorically. Those are horrible investments. But these offer us a high return, a guaranteed principal, and we're able to pull money on a monthly basis. So that's what we use. They're laddered portfolios, and if interest rates go higher, we will adjust higher. If interest rates go lower, At least we've laddered them out with cash, 3-year, 5-year, 7 and 10-year. It takes the interest rate risk away because these are principal guaranteed. You cannot lose money. And it takes the guessing game for interest rates away also, because if interest rates go higher or lower, we don't care. We're in a good position.
If you'd like to talk about this for yourself, your family, your portfolio, how are you set up, or regardless of what happens, we're certainly going to allow you that opportunity, and there's no cost. Complimentary talk with Brian and the team at Decker Retirement. It is 833-707-3030. And realize this, everybody's situation is unique. So everybody's situation will be a little bit different in how their portfolio is set up, how much income we need month after month, and so forth and so on. Some have health issues. I mean, there's a lot of variables when it comes to retirement. Brian and the team are here to help you, if they can. 833-707-3030. And again, Brian's book is now revised with all the new Secure Act stuff, all the new stuff that's going on. All you have to do is go to the website, DeckerRetirementPlanning.com, under the heading of Safer Retirement Education. Brian's book's right there on retirement, the Decker Approach Book, newly revised. Check it out. You can get it. Take it right there. It's no cost to you, no obligation. Again, if you want to talk to him, though, it's 833-707-3030. Back with more with Brian J. Decker of Decker Retirement Planning right after this.
You have enough things to worry about. Market volatility shouldn't be one of them. Make sure your retirement plan doesn't rely on the ups and downs of the market. Call the Decker Retirement Planning Team to get started at 833-707-3030. That's 833-707-3030.
Do you want your retirement to be affected by who was in the White House? I didn't think so, but here's the thing. No matter who wins this time, they'll only be in the Oval Office for 4 years. But how long will your retirement last? Presidents can have a huge impact on taxes and the economy, but there is another presidential election in 4 years, then another, and of course another. Brian Decker at Decker Retirement Planning can help you create a customized plan that's really as White House proof as possible. Schedule your visit with Brian Decker today by calling 833-707-3030. Brian doesn't know who will win in November, but he can help you prepare for it, no matter what happens. Reach out to Brian Decker to get started. Call 833-707-3030. Don't let who's in the White House affect your retirement. Call 833-707-3030. Investment advisory and insurance services offered through Decker Retirement Planning, Inc., a registered investment advisor.
You're listening to Safer Retirement Radio. If you like what you hear on today's show or have questions, drop by DeckerRetirementPlanning.com or call 833-707-3030 to talk to Brian.
Welcome back to Safer Retirement Radio with Brian J. Decker of Decker Retirement Planning. I'm Mark Elliott. Glad you're with us. Again, DeckerRetirementPlanning.com to learn more about Brian, the offices, where they are, the team that Brian has created. Really here to help you figure out where you are on that road to retirement. Plus, all those things you can get under the heading on that website, DeckerRetirementPlanning.com, under the heading of Safer Retirement Education. 12 different things you can download, including Brian's brand new revised book, the Decker Approach Book. It's all there for you. It's all there for your information. No cost, no obligation. It's all free. Take what you want. You want to gain knowledge about this? Pick it up. There's an sample income plan in there. Grab that if you want to. There's a checklist challenge. See where you are. Get that. 3 Principles of Retirement book plus Brian's book. Those are 4 of the 8 things you can get right off that on their website, DeckerRetirementPlanning.com, under the heading of Safer Retirement Education. 833-707-3030 if you want to have a conversation. Let's get started. Let's figure out where you are. That's really one of, I think, the biggest bonus to taking advantage of this opportunity to talk with Brian and the team. No cost to you, and you're going to get real clarity into your retirement picture. You're going to know, do I have enough? Do I not have enough? Are we close? Or can we retire? 833-707-3030. We're talking about interest rates. And we know in 2022, the Federal Reserve raised interest rates 5 different times, 4.25% total in 2022. 2023, they raised the interest rates 4 more times, all at a quarter basis point, so ended up 1 more percent. So 11 times in the 2 years, 5.25% total. In September of 24, they just lowered the interest rate level, the Fed did, by 0.5%. So we're talking about interest rates and how if interest rates go up, bond values go down. If interest rates go down, bond values go up. So in a way, aren't bonds trending favorably right now if the Fed's going to keep reducing interest rates?
Yes, but the Fed is lowering rates while the open market rate from bonds, if you look at TLT, if you put that symbol in and look at it, it measures the long-term, the 30-year treasury yield. Yields in the open market have gone higher while the Fed is lowering rates on their open market bank loan rate. So the loan rate that they set, the fixed rate, is going down. Hopefully that's good news. For example, home loans, that's good news. But when rates got lower, Mark, you remember when the 10-year treasury in 2020 hit 0.47 in August of 2020, that was a tax on retired people. Their CD rates were in the tank. They weren't getting much of a return on anything that was safe. But what options did they have, right? So to take away the guesswork on interest rates, no one on the planet knows what's going to happen with interest rates. So don't even guess. Don't hold your money and say, oh, I'm going to invest, I'm going to lock in the highest rate. No, that doesn't make any sense. Our clients have peace of mind. They don't need to guess what the rate is going to be. If rates go higher, a portion of the laddered portfolio that we have goes higher, doesn't have interest rates. And if rates go lower, then thank goodness we've got 3-year and 5 years locked in with CDs. So the 7 and 10 year is the key part for our clients, where if interest rates go higher, they're able to see their return go up and not have principal loss like bond funds. So I just want to end this segment on this topic saying, you know, in your 20s, 30s, 40s, 50s, no big deal if your portfolio goes down 30, 40, 50%. No big deal. Your income comes from work and you have the 3 to 5 years time to let the markets recover. Because you're kicking money in every 2 weeks into your 401k, you actually benefit from that market drop. But once you turn 60, 65 and you're retired and that portfolio is generating income for your golden years of retirement, and it's supposed to last you 25, 30 plus years in retirement, when that portfolio drops 30, 40, 50% and you're drawing income from it, you don't have the time, you're not adding to it, you're pulling from it. And that is devastating. Many people have to go back to work. Many people did have to go back to work in 2008. So there's many problems with bond funds in a rising interest rate environment. We are in a rising interest rate environment. No matter what the Fed is doing, it's interesting that even with the Fed rate cut, open market yields on bonds and bond funds, yields are going higher and bond fund prices are going down. I'll end this topic by just saying, if anyone has an advisor telling them that their safe money should be in bond funds, I hope they give us a call, because that is devastating to people in retirement, losing principal on your quote unquote safe money. Also, if anyone has an advisor recommending a 60-40 portfolio, that should be strike two. 60% of all you've earned at risk in the market, one bad year like 2008. By the way, every 7 or 8 years, these market disasters swing through. Every 7 or 8 years, they seem to just like clockwork swing through the markets and send people back to work. It doesn't make sense to have 60% of your portfolio at risk in the markets. Our clients have the opposite. They have about 25% of their portfolio at risk and 75% of their portfolio with no risk. And when they come in, they're surprised at how much more they're getting in retirement in monthly income than what they were offered with their previous advisor. So they're getting more income, less risk. And I default to this analogy. When I had my right knee replaced, Mark, I didn't go to a dentist. Dentists are good people, but they didn't do what I needed to do. I went to an orthopedic surgeon that specialized in knee replacements. We specialize in retirement planning. Bankers and brokers are good, honest, hardworking, ethical people, but they are accumulation focused. They are not distribution focused. In retirement, it is about keeping what you've earned and distributing income from it while you're in your golden years of retirement.
833-707-3030 is the number if you'd like to have a conversation with Brian and the team at Decker Retirement Planning. No cost to you, totally complimentary. 833-707-3030.
So, Mark, on the election uncertainty, no one on the planet knows who's going to win the election. Half the country is fretting that the
You can bet on it now. You can bet on it now.
I see that. And the betting markets are going back and forth. It looks close. But history says, over 100 years of history says, surprisingly, it doesn't matter. Now, half the audience, radio audience, says Brian's delusional. It does matter. Half the listeners might think that we are going to have the economic disaster and crash. We'll see. It'll be interesting to see what happens if you believe that. How much risk and exposure do you have in your retirement portfolio if you think you're going to get nailed? Our clients have about 75% of their portfolio with no risk. They sleep well at night. They're not worried about the election. We are not getting calls fretting about the election. Our phone's not ringing about how much the markets are going to go down if so-and-so gets in. But history shows that whether it's Republican or Democrat, the markets just seem to focus on one thing, well, two things: corporate earnings and interest rates. Those things are very, very important. Corporate earnings and interest rates. Now, if one side is going to squeeze corporate earnings more than the others, then yeah, it's going to have an effect in the stock market, but we'll see.
So there certainly is a lot up in the air in our country. We're all looking forward to this being over, I think, at the end of the day. But your point is well taken, that typically the markets, there's not that much difference. If you go, hey, Democrats won the White House. Well, here's their average market for that next year or during that term. Same thing for the Republicans. There's not much difference. I think the Republicans might be a percentage or two higher returns than Democrats, but I mean, they're both 9 to 11% or something. So at the end of the day, whichever party wins, that's not the key. The key is you having a plan, and Brian and the team are here to walk you through the safer retirement process: income, investment, taxes, healthcare, legacy planning, Social Security, Medicare decisions. It is about you. And do you like the idea of 75% of your portfolio safe, doesn't matter what happens? The other 25, it's in the game because you need money to last as long as you need it to. So it's got a little more risk to it, no doubt about it. 833-707-3030 is the number to chat with Brian and the team. Again, totally complimentary, no cost to you. 833-707-3030. Halfway through today's Safer Retirement Radio with Brian J. Decker of Decker Retirement Planning. Stay with us. More to come right after this.
In the world of taxes, knowledge is power. Let the team at Decker Retirement Planning empower you with the insights and strategies needed to navigate the complexities. Dial 833-707-3030 to stay ahead of the tax game.
Glad you're with us today for Safer Retirement Radio with Brian J. Decker of Decker Retirement Planning. I'm Mark Elliott. You can always learn more on the website, deckerretirementplanning.com. And a reminder, Brian's book, that's one of the 12 different things you could download under the heading of Safer Retirement Education on the deckerretirementplanning.com website, is Brian's revised book, the Decker Approach book. Secure Act has changed a lot of things for retirees. They did that in 2019, 2021, went into effect 2020, 2022. They changed RMD ages. They changed a lot of different things. So the book has been revised and upgraded to where we are right now. If you'd like that book, just go to the website. It's deckerretirementplanning.com under the heading of Safer Retirement Education. You can download it right there. Pretty simple. So that's all for you. If you have questions, you want to sit down with Brian and the team, it's 833-707-3030. Maybe you just have a question. Hey, Brian, we're thinking about retiring next year. Are we in a good place? That'd be great to get that answer, I would think. 833-707-3030. All right. We're talking about things that are going on, right? The interest rates, the Fed dropped the interest rate level in September 0.5%. 2022, they raised the interest rate 7 times. 2023, they raised the interest rates 4 times. For a total in that year and a half, 2-year period, 5.25%. Well, we just got a 0.5% drop. How does that affect things? So Brian was talking about the first part of the show was really about interest rates, how you're affected by that. The interest rate levels go up, typically bond values go down. If interest rates go down, bond values go up. So kind of work like a teeter-totter. But that's not always the case. So Brian can help you figure all of that out as well. But here's a stat for you, Brian. So since 1929, that was probably right before the Great Depression. Since 1929, there have been 14 instances where the Federal Reserve has cut rates. In 12 of those 14, the S&P posted positive returns over the following 12 months. The only 2 times it didn't, out of those 14 times, 01, dot-com bubble bursting. Market of S&P was down 13%. 07, that was our subprime mortgage crisis, the housing and banking financial crisis. It was down 17%. So those are the only 2 times when the Fed had cut rates that the S&P was not above it. But all of that is tied to the market. And you're going to talk about the market challenges that we have now, market trends, what's up, what's next, where are we going? Kind of the same thing here. You said we can't really control the interest rates. We can't really control the market, but we can control how we invest, I suppose.
Right. So when it comes to the stock market, well, let's go back to something you said on interest rates. So when the Fed, in 100 years of history, if you're a betting person, you don't want to bet on a soft landing. A soft landing is when the Fed cuts interest rates and allows the economy to just keep on chugging. Usually the Fed cuts rates to stimulate the economy. Usually they're too late. In 100 years of history, every time the yield curve has inverted, where short-term rates are higher than long-term rates, and the Fed cuts rates, that's what starts the clock. In the next 12 to 18 months, there's been a recession every time except one time. So if you're a betting person, you should expect that there's going to be a weakening economy at the very least. Now, it's interesting that that's why the Fed didn't go for 25 basis points. Now, remember, they have a choice to make between, in cutting rates, do they look at inflation and not cut rates? Or do they try to save the economy and maybe tinker with a rate cut of 25 basis points or 0.25%?
Of course, in that 2022, 3 times they raised it 0.75%. Those were the biggest ones.
And they did that because they had to fight inflation. There's 35 trillion reasons why they want to keep interest rates low, which, by the way, is the deficit. We do not want a deficit interest rate higher than it needs to be. Ideally, if we can lower interest rates, that's better for the economy. That's better for our national deficit. Is that better for retirees' rates on their CDs? The answer is no. When it comes to retirees, low rates are a tax on retirement. The retiree wants the cake and eats it too, wants a low interest rates on their mortgage rate, wants a high interest rate on their CDs. But when it comes to the intensity of the recession, if there is one, it's usually measured in how long the yield curve was inverted. Well, in 2008, that was a 50% peak to trough drop, and the yield curve was inverted before 2008 by 24 months. Well, we've gone back and forth, but there's been sequentially 27 months of yield curve inversion. So if we use that as a measurement, there's going to be some rough sledding ahead for the stock market coming up. And let's talk about that. With the election uncertainty, with the potential for market drops, let's talk about how you're protected. Mark, how would you feel if I did the typical banker or broker, had you in a 60-40 portfolio? 60% of everything you've worked for is at risk. 40% is in bond funds, which, by the way, in the last 4 years have lost over 30%. That stings. But you've got 60% of all that you've worked for at risk in the market. And oh, by the way, you should sleep well at night because we ran a Monte Carlo simulation and it said that 92% of the time you should do just fine. Does that work for you, having that 8% looming out there?
Yeah, I'm okay. You got to take some risks to make some money. But I will tell you this, I started my job in 2014. So I got the 401k and I thought, you know what? In 10 years, 11 years, 2025, I'm going to be 65. So I'm going to go target date fund of 2025. And in 2017, 2018, I'm looking and going, man, the markets have been good. Why am I making no money? It's because of the target date fund bond portfolio, I think. And so I moved it out to 2035, and my thing has done way better. It takes more of a hit, I suppose, but that's okay. I need growth. But at the end of the day, I'm thinking about going with William Devane, going 60% gold, 40% silver. What do you think of that?
Well, you better hope that it's not inflation, it's not geopolitical events that moves gold. It is one thing, and that's a declining U.S. currency. US
it's
dollar.
all about the dollar, isn't it? Yeah.
Yep. So interest rates have gone down, but what has the dollar done in the last 6 weeks? It's gone up. What is the bond rate, open market bond rate done? Yields have gone up. What has gold done in the last 6 weeks? It's gone down. So you
I'm
need
in trouble.
to hope.
I had 60% gold, 40% silver then.
Yeah, you need to hope that from now on, and this affects gold and silver and all commodities, you need to hope that the US dollar goes down. Now it's the Fed is expected to continue to cut interest rates for the next 18 months. If they do, inflation has got to get their attention at some point. Anyhow, let's go back to market uncertainty. In your 20s, 30s, 40s, 50s, you can take all the risk you want because your income's coming from work. When you are retired, you've got to protect your portfolio. Your portfolio's got to last for the rest of your life, number one. Number two, it needs to generate income along with your Social Security, your pension, or rental real estate, your other income streams. So how much of your portfolio should be income generated? Well, Mark, if you look at a pie chart, you have no idea. Even you, as brilliant as you are, no one on the planet can look at a pie chart and see how much money they can draw for the rest of their lives. So the first point is making sure that you know. And by the way, the number one fear in retirement is running out of money before you die, I believe, because people are told by their banker or broker, their advisor, to use the pie chart as their retirement plan. And it's not. It is not a retirement plan. Real quickly, because I want to get back to market uncertainty, market volatility. A retirement plan looks like our distribution plan. On the middle to the left side, it shows all of your income sources, income from pension, income from Social Security, income from rental real estate, and portfolio income. We add them all up. We get gross income minus taxes. That gives annual and monthly income with a COLA, cost of living adjustment, to age 100. Why 100? Because we want to make sure your money outlives you. And without that spreadsheet, without you knowing how much money to draw, you can't know how much money each year you should draw and add a COLA in unless you have that distribution plan. So that's just a quick plug. If you want to see our plan, you can go to our website at deckerretirementplanning.com. You can order the book. That's discussed in the book. But I want to focus on this last piece for this last half of the radio show, and that is market uncertainty, market volatility. What if markets do go up from here? You don't want to sell out because your candidate didn't get elected. You won't know when to get in. It's be very tough for you to get back in because people, let's use Trump, for example. Some people thought that Donald Trump was going to devastate the economy, and they missed out on all the gains from 2016 to 2020. That was a good market. Equally, the Republicans, who swore that Joe Biden was going to destroy the economy, missed out on a lot of market gains from 2020 to present. So how do you handle market uncertainty and market volatility? Well, we went and did our homework. Again, just like on the principal guaranteed accounts, where we use Wink database to do research on the highest earning principal guaranteed offerings from banks and insurance companies. We look at that on a monthly basis to make sure our clients are getting the highest returns in each segment of their portfolio. In cash, 1 to 3 year, 3 to 5 year, 5 to 7, and 7 to 10 year principal guaranteed accounts. Well, what about risk? Well, we use and have subscriptions to the biggest databases in the world. Morningstar database, largest database of mutual funds in the world, the Wilshire database, largest database of money managers in the world, and 3 others. And we've done our homework. We know what the highest earning risk strategies are since 1950. In fact, we know biggest study ever done, Jake O'Shaughnessy's book, What Works on Wall Street, it's 367, Appendix A. He talks about what has produced the highest returns in positive markets. And those are momentum strategies. Those are sector rotation strategies. And those are also relative strength strategies. They all mean the same thing. Every stock is ranked from 0 to 100 based on relative strength, which is a function of price appreciation and volume. And momentum has you investing in the top relative strength stocks until something better comes along, and then you rotate into it. So, Mark, in the next segment, I'm going to describe in detail how momentum risk investing takes the uncertainty out of what you should be invested in.
So a lot going on in our world. There is no question about it. The question is, how much control over your retirement do you actually have? You actually have a lot. You kind of control when and how you pay taxes. You don't control the tax rates. You don't control the brackets. You don't really control the election. We can certainly put our vote in, but states typically go one way or the other, regardless of who the candidate is, which is kind of crazy. But anyway, so really it's about you. And that's what Brian and the team are here to do, is help you figure out where you are, where your family is, where are you going, what are you going to do, how are you going to spend your time in retirement? Do you know where your income is coming from? Do you know how much you need? Do you know how much you need to make sure it lasts as long as you're here? What about healthcare? What about taxes? All that stuff is a part of the safer retirement process, but it's about you. 833-707-3030 is the number. Again, no cost, totally complimentary. 833-707-3030. No cost, great opportunity for you to get clarity into your retirement picture just by picking up the phone. 833-707-3030. Back with our final segment of Safer Retirement Radio with Brian J. Decker of Decker Retirement Planning right after this.
Crafting your legacy is like planting seeds for a future forest. Let's nurture your vision together. Speak with Brian and the team at Decker Retirement Planning at 833-707-3030 to ensure your legacy grows strong.
Have you noticed the market's roller coaster ride lately? Even a single day's dip can significantly impact your retirement. If the idea of shielding your nest egg from market volatility resonates with you, it's time to talk to the experts at Decker Retirement Planning. Call us now at 833-707-3030. Our unique approach aims to dial down the risk, keeping about 25 to 30% of your assets at risk, instead of the conventional 60-40 pie chart. At Decker Retirement Planning, we don't use a pie chart. We strive to offer you a detailed retirement income plan. It's about seeing the bigger picture, aligning your investments to your long-term goals, and making informed decisions. Whether you're new to retirement planning or already have a plan, we can help. Call Decker Retirement today to learn about the 6 things we do well for our clients that all financial advisors should be doing. Call 833-707-3030 today. That's 833-707-3030. Investment advisory and insurance services offered through Decker Retirement Planning, Inc., a registered investment advisor.
You're listening to Safer Retirement Radio. If you like what you hear on today's show or have questions, drop by DeckerRetirementPlanning.com or call 833-707-3030 to talk to Brian.
Glad you're with us today for Safer Retirement Radio with Brian J. Decker of Decker Retirement Planning. I'm Mark Elliott. 833-707-3030. If you want to find out where you are on that road to retirement, do we have enough? Are we going to be okay if we retire? Can I retire? Well, when? 833-707-3030. We're talking about some of the challenges. The Federal Reserve dropped the interest rate level of 0.5% in September. They say, Brian said they're going to do that over the next 18 months as well. How does that affect things? And obviously, when you get to retirement, we would prefer higher interest rates. While we're buying houses and cars, we'd prefer lower interest rates. But to be safe and use safe tools, you need a little bit higher interest rates. So it's all a give and take. And Brian and the team are here to help you figure out your situation. Again, that's 833-707-3030. You were talking about market trends, but you're talking about momentum in the market is kind of a big deal. Explain.
Right. Momentum takes the guesswork out of where to invest in the market. So again, if you weren't with us in the previous segment, in retirement, you might be a little anxious about the election, market uncertainty, expected market volatility, what to invest in. Momentum answers all of that. So again, relative strength ranks all the stocks from 0 to 100 based on relative strength score with price appreciation and volume. Momentum has you buying the top relative strength stocks until something better comes along, and then you rotate into it. It is momentum. It is relative strength investing, and it is sector rotation. So for example, how does it work in a down market? Let's look at a few of them. All the down markets in the last 20 plus years. In 2000, 01, and 02, the S&P was down 50%. NASDAQ was down 70%. And during that period, there were many parts of the market that were doing beautifully. Momentum buys what is going up. So for example, you would have owned real estate through the REITs. You would have owned gold, silver, energy, pharmaceutical, biotech, healthcare. All those stocks made double digits each year for 3 years in a row. You would never have known any losses during those 3 years because those stocks and sectors did very well. Then the markets bottomed in March of 03. And what took off for the next, 4.5 years, you would have invested into technology, semiconductors, small caps, emerging markets. They exploded to the upside. And then rolling into 2008, another down market, you would have been stopped into cash because nothing was going up. It was a waterfall decline. So you would have had a cash-heavy portfolio with one exception, and that's Treasury bonds. Treasury bonds made 22% in 2008, and then the markets took off again. I'm going to roll forward to another down market, which was 2022, most recently. So in 2022, S&P's down 19, NASDAQ down 33, bonds down 20, commodities across the board were down, with the exception of energy, the frackers, the drillers, the natural gas companies, the crude oil companies, and the pipeline. They made 15 to 20 when most people were down 30% that year. So there's a time to be in technology. For example, in the last couple of years, if you haven't owned technology and semis, you've left a lot of money on the table. But if you own technology and semiconductors for the first 9 months of 2022, you lost 30%, boom, just like that. There's a time to be in energy, a time not to be in energy. There's a time to be in commodities, a time to not to be in commodities. Time to be in real estate, time not to be in real estate. What's going to happen with the election? These two different administrations are going to govern quite differently, and their effect on the economy may be quite different this time. I told you in the first segment that history showed that there isn't a big difference as far as S&P index returns between administrations. We have checks and balances, who's running the Congress, the House and the Senate, who's running the White House, there's checks and balances. So historically, it hasn't mattered. But what if you really want to invest in the best parts of the market? So now the managers that we use, we have 5 different strategies of momentum that we use for our clients on the risk side of their portfolio. Since January 1 of 07, when these managers started, the S&P is averaging 9.2% average annual return. These managers are averaging twice that, because they're cherry picking the best parts of the market to invest. They're not investing in the entire index. They're investing in just parts of it. So and we further split the strategy. When the S&P is trading above the 200-day moving average, the market is said to be in an uptrend. Uptrends make you money. So we have, just like in the NFL, we have the offensive team on the field when the market is trending higher. So when the market is trending higher, we have 5 strategies that are in place, able to make money and cherry pick the best parts of the market. But when the S&P crosses the 200-day moving average, we pull the offensive team off the field. We put the defensive team on the field. These are 4 different momentum strategies, very sensitive to invest in whatever is going up in a down market. They've made money in all the down markets since they started in January 1 of 07. They made money in 08. They made money in 2015, 2018, and 2022. That's very important. In retirement, you cannot afford to take a hit. But on the other hand, you cannot afford to be out of the market because you need that growth for inflation protection. You need part of your portfolio to have exposure to those higher returns to beat the inflation risk that clients have in retirement. If you have a fixed pension, for example, what was good 30 years ago is not good now. And so this is a way to hedge for inflation by having a portion of your portfolio in the stock market. There's one more thing, Mark, that's really, really important, and that's how the markets have changed. This is very, very important. So we have uncertainty of the election, but what I'm going to tell you now is even more important, and that is markets have changed recently in how you invest or how you should invest. In the last 100 years, there's only been 4 times that the S&P 500 has traded above a market valuation of 30 times trailing earnings. That's only happened 4 times. One was 1929, and markets were flat. It took you 17 years to get your money back. 1964 was the second time, 18 years to get your money back. Third time was November of 99, 14 years to get your money back. The fourth and final time in the last 100 years was November of 2021. We hit 32 times trailing earnings. If history repeats, and history's been 100% on this, this is very important. Any passive investment strategy, buying and holding stocks, mutual funds, indexes, or ETFs, will yield a 0 return over the next 10 to 15 years. That is devastating to someone in retirement. You cannot afford to buy and hold and lose 10 to 15 years of returns. So for many reasons, market uncertainty, election uncertainty, in retirement, not being able to handle these big losses, and also how we've just entered a flat market cycle. For a lot of reasons, we hope that you get in contact with us and learn more about momentum strategies in risk. Now, we help clients lower their risk in retirement 3 different ways. One we just talked about, and that is strategically. We have an offense and a defensive strategy using momentum, sector rotation, and relative strength, allowing us to not have to, we automatically buy whatever is going up. Are commodities going to go up in the next 4 years because of inflation? We don't know. We don't care. The risk models will automatically adapt. Are commodities going to go down? Interest rates going down because the Fed is cutting rates? We don't know. We don't care, because the momentum strategies will make that choice for us. So one of the 3 ways that we lower client risk is strategically by using an offense defense with momentum strategies like we just talked about. Second, we don't use bond funds because of interest rate risk. That is a risk that is easily cut, and we do not use bond funds in retirement. Your safe money, quote unquote, that other bankers and brokers have advised you on is down 35% in the last 4 years. How safe is that? And third and final, quantitatively, we lower your risk. Any advisor that tells you to put 60 or 70% of your retirement nest egg at market risk is insanity, in our opinion. We quantitatively lower your risk to about 25%. Yeah. So in this segment, we've talked about market uncertainty, how a true retirement planner helps people in retirement lower their market risk. They don't have to guess on the market. They don't have to guess on interest rates. They don't have to guess on the election. All of that is taken away in a distribution plan with laddered principal guaranteed accounts, like we talked about, occupying about 75% of the portfolio. And the other 25% is in momentum strategies with an offense and defense that takes away the uncertainty of the market and dramatically lowers their risk.
So here's the deal. If you're like me and you're like, holy cow, that's a lot for me to figure out when I don't really understand the financial world. I need Brian's team at Decker Retirement to just take care of it for me, create my plan. Know what I need, they can help. But there are others that really were right in with every word Brian's saying because you're on top of the financial world. Maybe you need to come in for a second opinion to make sure what you're doing is the right thing. Everybody's unique. And that's how Brian and the team at Decker Retirement look at it. And how can they help? Can they certainly give you clarity into your retirement picture, which I think is back at the old MasterCard commercial. That's priceless. Actually knowing where you are on that road to retirement. 833-707-3030 again is the number. Totally complimentary. No cost to chat with Brian and the team. 833-707-3030. And if you'd like the new revised Decker Approach Retirement book, just go to the website, DeckerRetirementPlanning.com, under the heading of Safer Retirement Education. It's right there just for you. Your information. Again, it's 833-707-3030. Brian, thanks for all the information all the time. Always enjoy it. Have a great week. We'll do it again next week.
Security and insurance services offered by Decker Retirement Planning, a registered investment advisor with the SEC. Investing involves risk, including the potential loss of principal. Any references to protection, safety, or lifetime income generally refer to fixed insurance products, never securities or investments. Insurance guarantees are backed by the financial strength and claims-paying abilities of the issuing carrier. This radio show is intended for informational purposes only. It is not intended to be used as the sole basis for financial decisions, nor should it be construed as advice designed to meet the particular needs of an individual's situation. Decker Retirement Planning is not permitted to offer, and no statement made during this show shall constitute tax or legal advice. Our firm is not affiliated with or endorsed by the U.S. government or any governmental agency. The information and opinions contained herein provided by third parties have been obtained from sources believed to be reliable, but accuracy and completeness cannot be guaranteed by Decker Retirement Planning. This radio show is a paid placement.